moving on, let's look at some real world trading examples and to combine the trading strategies, techniques, and concepts that you've learned, right? And see how we can apply it to the real world of trading using real charting examples. So this is the chart of dollar against the South African rand, as you can see over here. This is on the daily time frame. So first and foremost, let's ask ourselves, what is the market structure? So when we are trading the markets, this is the first question that we want to ask ourselves. What is the market structure? This would tell us what to do, whether to be a buyer, seller, or to stay out of the markets. So if you look at this market structure, we see a series of lower highs, lower highs, lower high, and lower low, lower low, lower low. So we can see that this market, the market structure is in a downtrend. Second thing, the area of value. Let's put it AOV. Is there an area of value over here? So area of value could be things like moving average, support, resistance. So from what I'm seeing over here, there is an area of value over here. I can just use this tool over here, and to draw this area of resistance over here. I'll just change this to black color. Okay, so now we have an area of value over here. So do we have a valid entry trigger? So remember the candlestick module or section that we just covered? This over here looks like a bearish engulfing pattern. All right, so let's put it a bearish engulfing pattern. So from the looks of it, right, we have a numerous factor, right, working in our favor. Number one, the market structure is in a downtrend. Area of value, the price is at resistance. Our entry trigger, we have a bearish engulfing pattern that's being formed. So in this case, right, we can look for a short trade, right, to short this market in expectation of lower prices. And of course, right, this is clearly a cherry pick chart. In this case, the price, went in our favor. Okay, so now moving on, let's look at another trading example, right, using the market structure, area of value, and candlestick patterns that you've just learned, and use it to help you make a trading decision to know whether to buy or sell. So again, let's revisit, right, what we have learned. Number one, ask ourselves, what is the market structure of this currency pair? This currency pair is New Zealand yen on the 8-hour time frame. So market structure, as you can see, this market structure is in an uptrend. Price forming a series of higher highs and higher lows. Here, higher low, higher low, higher high, higher high. Okay, what about area of value? Can you see it being near any area of value? So from what I'm seeing over here, the price has retested this area of support, right? Support, support, and support. And also previously, this was actually resistance. So price broke out of this swing high resistance and became support. Now, what about entry trigger? Is there any signal entry trigger that tells us, hey, it's time to enter a trade? So if you look at this candlestick pattern, right, this over here, what does it look like to you? This, right, I would say it's close to a bullish engulfing pattern, but as per the definition of bullish engulfing pattern, this isn't quite one because this green candle didn't cover the body, right, of this red candle. But that isn't going to stop us and say, hey, this is not a bullish signal, it's not time to enter. Because if you read the candlestick pattern, if you read the price action, it's telling you that the buyers, they did, right, close higher for the day. And they did show you signs of strength, right, closing near the highs of the day and almost, right, the previous day opening price. So it closed pretty strongly. So this few reasons, right, market structure, the area of value, and the entry trigger, right, is the story is telling you that, hey, you can now look for a buying opportunity. So what you can do is you can enter on the next day open. Let's say on this candle here, the next day open, which is on this candle here. Okay, so now what about stop loss? Now you know where to enter, which is very simple, the next day open. But stop loss is something that I've not covered, and I want to talk about in this example here, since it's quite straightforward. So when it comes to stop loss, right, you want to set your stop loss at a level which invalidates your trading setup. So what I mean by this, so for this particular trading setup that you're trading is in the direction of the trend, uptrend, and buying near an area of support. So this means, right, if the price breaks below support, then it means your so-called hypothesis, right, is wrong, right? Because this is the area of support that you expect the price to hold. If the price breaks below this area of support, then clearly this so-called theory, this hypothesis that you had, that this trade could move higher, is clearly wrong, and you want to exit your trade. So to do this, right, it's very simple. What you have to do is to set your stop loss at a level, right, which will so-called break support. So if you look at this, right, clearly, anywhere from 72, 50 or below, right, at this level, clearly if the price breaks down and hit this level, this area of support is broken, and you want to exit your trade. But so is there a objective way, to set your stop loss instead of you just blindly, putting it at some level that looks like, far away from support? And the answer is, of course, yes, right? And to do that, you can use an indicator called the average true range. So over here, I've shown you this indicator below, but I'll show you where to get it. Just go to indicator tab, search ATR average true range. It will come out as this one over here. The settings I like to use is 20 period ATR using SMA. So it's just my preference over here. And as you can see right now, the ATR value is about 0.322, about 32 pips. So what this tells you is that on this time frame, for New Zealand yen, on the 8-hour time frame, over the last 20 candles, right, this currency pair moves an average of about 32 pips on average. I'm not saying every single candle, but on average over the last 20 candles or so, this currency pair has moved about 32 pips. So what this means is that you can actually use this value, right, and give it some buffer, right, to set your stop loss below support. So let's say, for example, the lowest of support is at this level over here. What you can do is take this level and minus, let's say this level is X, right, and you minus this ATR value, this one ATR value. Okay, so 1 ATR is equals to 32 pips, right? And let's say you get the value of Y. So let's say Y is somewhere about here. This, right, can be your stop loss. And it's an objective way to set your stop loss based on the volatility of the market. Since ATR indicator, takes into account the volatility of the market. So let me walk you through how to actually set your stop loss. So what you want to do is to find out what is this low of support. So in this case, right, the low of support, the value is on this candle here. And the value is about, from what I'm seeing over here, it's $72.72. So you just look at this L value, which is the low of the candle, and you can see it's about 72.72. So what I'm going to do is take 72.72 minus 32 pips, sorry, 72.72, and I minus 32 pips, which is 0.32. That is going to give me a value of about 72.4. Am I right? Okay. So what I'll do is I will set my stop loss at this level at 72.4. Change this to rate so you can see it better. And your stop loss will be at 72.4. Okay. So as you can see over here, I will show you where is your entry point. Your entry point is on the next day open, the candle. Put it in green so you can see it. Green. Okay. And there you have it, right? So this candle here. This candle here, the opening price is where you look to buy. This rate level here is your stop loss. So now let's take things a step further, right? If you have a $10,000 trading account and you want to risk 1% risk on each trade, how many units of New Zealand yen can you buy? Okay, so now what we need to do is to again revisit the concept that you've learned. So what you'll do is, first and foremost, measure your entry price to your stop loss. So your entry price, let's make this more precise. Let's say your entry price is at this opening price of this candle, which is about 73.31. Okay, so I'm going to change this to 73.31, and your stop loss is 72.4. So you take 72.31, take 72.31 minus 72.4. That gives me a 91 pip stop loss, 91 pips. Okay, so what do we do with this information? So how do I get 73.31? Again, the entry price on this candle over here, the opening price is 73.31. Stop loss is 72.4, which is this level here minus 1 ATR. And it gives us 72.4 as our stop loss. And we take the entry price minus your stop loss, right? And this is your distance, right? In pips, right? For stop loss. So in other words, from your entry price here all the way down to here is 91 pips. So now the question is, how many units of New Zealand yen can we buy such that we don't lose more than 1% of our account? So time to revisit your position sizing. So let's go to this. So let's say currency pair is New Zealand yen. Type in New Zealand yen. Account currency, let's keep it, as USD. Let's say your account size is $10,000. Risking 1% on each trade. Your stop loss, as mentioned earlier, is about 91 pips. Calculate. It tells you that you can buy 0.121 lot, which is about 1.2 mini lots. Okay, so you're going to trade this, on a I hope it's a demo account, right? You can buy 0.121 lot. Okay, which is about 1.2 mini lot. Does it make sense? So you can see that we have, used a number of, concepts that you have learned earlier. The market structure, area of value, entry trigger. Then we learn how to set our stop loss. We learn how to calculate the optimal position size, right, such that we don't lose more than 1% of our trading account, as shown in this position sizing calculator over here. Okay, so how are you feeling? Do you feel overwhelmed? There's so much to cover. Well, don't be, because if this is your first time, watching this video, or you're new to Forex trading, yes, it's perfectly normal to feel overwhelmed and confused. But this is nothing, new. This is actually all the topics that we have covered in the earlier part of the video. If you're unsure, you can, just go back, watch through the videos, and to clarify, on any concepts or techniques, right, that is unclear to you. So I'm going to, go through another example, because this is so important, right? Understanding the position sizing, the risk management as well, how to analyze the chart, and how to combine all this together and place a trade so that you don't blow up your trading account. So let's have a look at another one using the same framework. So number one, ask yourself, market structure. What is the market structure of this currency pair? So this is the dollar against the Japanese yen, 8-hour time frame. Market structure is down. I'm just kidding. It's up, right? Higher highs and higher lows. Higher highs, higher low, higher low, higher low. Market structure is up. And then you have higher high, higher high, higher high. Area of value is the price near an area of value. As you can see over here, it is at this previous resistance resistance, which became support. And yes, this is an area of value. And not just that, right? We also have, if you pull out your 50-period moving average, right? This 50-period moving average also serves as an area of value. We tested once, twice, three times, and then fourth time over here. So this is what we mean by when we have like support and the 50-period moving average coming together, from two separate area of value coming together at a similar area. I call this stack areas because you have multiple factors coming together to work in your favor. So this is a stack area. You have the area of value of the 50-period moving average as well as previous resistance which became support. The third thing, right, do you have an entry trigger? So from the looks of things, when you studied the bullish reversal candlestick patterns earlier, this isn't actually any of the candlestick pattern which you have learned. But again, the memorizing of the candlestick pattern, the name is not important. What's important is that you can see a buyer stepping in, right, to push and close higher. It breaks and close above the 50-period moving average. Looking at the range of this candle is pretty nice and large as well, and the price is closed near the highs. So this tells you, the buyers are in control, right, and managed to close right near the highs of this 8-hour time frame. So what we can do is, again, to me, this is a valid trading setup, and you can look to buy. So let's say you buy on the next day's opening price of this candle over here. So now what about stop loss? So again, stop loss, we want to set it at a level which invalidates our trading setup. So our area of value is over here, this previous resistance which became support. Okay, we want to set our stop loss, right, a distance below support. We don't just want to set it smack below support because, like for example, this is directly over here, because the price will just come down, spike through it, and then continue higher. So if you set your stop loss just below it, this could happen to you, right, pretty often, and it sucks. So this is why I recommend, right, finding the low of support, right, and then just minusing off 1 ATR for it. So in this case, 1 ATR, it tells you it's about 34 pips. So what's left for you to do right now is to find out what's the low of support. The low of support is, again, right, let me look at this candle as the low. It's about 108, let's make it 109, as shown over here, right, this is the low. The low of support is about 109. So I'm going to take 109 minus 34 pips, okay? Using my trusty calculator, 109 minus 34 pip, it gives me 108.66. So this tells me my stop loss, right, should be at 108.66. I'm going to change this to rate. I am going to also change the coordinates to 108.66. Okay, this is my stop loss level. Great. So now I want to take things a step further, right? You know how to set your stop loss. You know your entry is at this price over here. Okay, let me just change this to green, about here. Entry price is this candle open, which is about 109.88. Okay, let me just change this to 109.88. So another thing to talk about is your target. So far we have talked about the trading setup, right? Market structure, area of value, entry trigger, to know when exactly to enter a trade. I shared with you how to set a proper stop loss so you don't get stopped out too early. And the final component that I want to add as well is to where to take profits, right, if the market moves in your favor. So coming from, let's say, a swing trading perspective, and bear in mind, there are many ways to take profits. I'm going to share with you one method, which is what we call swing trading, which is in essence, right, just capturing one swing in the market. So this is like one swing, right, from this retracement, and we pull up one swing. This is one swing. This is another swing. So basically one move in the market. I'm going to share with you how to do that. So to capture one swing in the market, we usually want to set our target profit at before, right, previous swing highs or low in the market. So you know what is swing, right? This is our swing point. Swing high, swing low, swing low. So if you're long, right, you want to exit right before the nearest swing high, because this is where potential selling pressure could come in, and push the price lower. So you're going to set your target before it. So in terms of target, I would say a reasonable target could be at this price point over here, before this. Remember, this over here is an area on your chart, not a line. So don't set your target, right, just, one pip below this high, because remember, it's an area. The price may not get to that high, right, before it starts to reverse. It could just, come close into that area, doesn't hit the highs, doesn't hit these highs over here, and then it starts to collapse. So if you're too, greedy with your take profit, you set it at these highs over here, or even over here, you're making it difficult for the market to, to give you a profit. So be reasonable with your targets. So my recommendation is to set it before the swing high. So let's say we set it somewhere about here, right? This I'll say is reasonable. And let's change this to blue color. Okay, so let's say our target is at, let's put it at a number that is easy to understand. 107 dot, let's say 72, okay? Okay. So now if you look at this right now, you can see that where is your entry price, which is this green line over here. Where is your stop loss, this red line over here. Where is your target, which is this blue line over here. So now again, let's revisit, position sizing, since that is so important, right? That is what keeps your account intact. Let's find out, right, the size of our stop loss. So basically from entry price to your stop loss, right? What is this distance over here? So again, just take the entry price minus the stop loss. So what you can do is you can pause this video and do the math with me and see whether you get the answer correct. So I'm going to take 109.88 minus 108.66. Right, so basically I'm taking this green number minus this red number. It gives me about 122 pips. Okay, that's the distance of my stop loss. So in essence, from here to here is 122 pips. So now let's use this number and find out, right, how many units of dollar against the Japanese yen can we buy such that we can still adhere to our risk management. So to do that, just go to look for dollar yen. This is the currency pair you're trading. Okay, let's say your account currency is funded in US dollar as well. Account size, let's say now you're a baller, right? 100,000 units your trade. I mean, your account size is $100,000. And let's say you are still the same, prudent trader. You still risk 1% on that trade. Well done. Stop losses, 122 pips, as we have mentioned earlier. I think it's about 122 if I'm not wrong. Yep, it is. Then you're just going to click, calculate, and it tells you that you can buy now 0.899 standard lot. This is equivalent to about 8.9, I would say 9 mini lots, right? You just round it up, it's about 9 mini lots or 0.9 standard lot. So in other words, hey, if you have a $100,000 account and you're risking 1% of that account, let's say 1% is $1,000 of your account, and you're trading this currency pair dollar against the Japanese yen, your stop loss is 122 pips. Okay, how many units of this currency can you buy? And according to that risk management or rather position sizing calculator you saw earlier, it's about 0.9 standard lot or 9 mini lots. It's actually 0.899. I just rounded up to make my life easier. So that's how you combine all these different elements together, this concept strategies, right, to make sense, right, out of your forex trading career. So let's now take things one step even further. Okay, so this is actually stuff we've covered earlier. I'm just revising it. So we're going to take things a step further, because one thing that you might not notice if you look at this, hey Rainer, this is my entry price, this is my stop loss, and this is my target. It seems that my stop loss over here, okay, let's call it SL, stop loss, is kind of smaller than my profit target, right? If I just pull it out, let's call it TB, target profit. My stop loss is wider than my target profit. And if you are thinking along those lines, you are absolutely correct. You can actually use a tool like this over here, okay, just use the long position one to help you assess, right, your risk to reward ratio. So just pull this tool out, right, just click this one, choose long, and if you're going to click, let's say you click on this green line, this thing will come out. So the way we're going to do it is that we're going to adjust this thing, right, such as this level here is at our stop loss, okay, and this one over here is at our target, the blue line, and this over here is smack at our entry point, which is fine. And you can see something very interesting. What it's telling you, how you actually make use of this tool, is that you can see you are risking 122.2 pips, right, which is your stop loss. 122 pips. And this over here, 84.7, is your target profit, what you have targeted, which is about 84 pips. So in other words, if you look from a risk to reward standpoint, you are risking $1 to potentially make back 69 cents as shown over here. 69 cents. How do I know 69? You can see over here, risk to reward ratio 0.69. You're risking $1 to make 69 cents. So it's not exactly very favorable, and most traders will say that's not really a trade I want to take, and I can perfectly understand that. So what can you do to make this risk to reward on your trade more attractive? So now there are a few things that you can do. Number one, you can of course, right, shift your target up higher. Okay, to a point where you now, okay, you're risking $1 and make $1.37 back in return. But as you know, to put your target over here, it's a bit of a, I won't say it's a stretch, right, since this is a trending market, but what has to happen is that the market, right, has to break above these highs to get to your target. So that's like kind of like a little bit more work, right, for the market to go through to reach your target. And I would say that's a lower probability, right, since the market has to break through above this swing high. But again, right, in the context of this price action that we are seeing, I won't say that it's impossible, because we are after all in an uptrend. But if it's a range market, right, this I would say clearly a very bad decision. So let's say we don't touch the target, right, let's keep the target the same, let's say around this level over here. Okay, this is our target, right? So what else can we do to make the risk to reward more favorable? What we can do is, again, we can shift our stop loss, we can make it tighter or shift it up higher. But again, we don't want to mess with our stop loss, because our stop loss is at a level where if it reaches, right, it will invalidate our trading setup. You don't want to exit your trade while the setup is still there. It doesn't quite make sense, right? You want to be buying and support is not broken, but you already exit your trade. That's not very, wise. So the last thing that you can still do is to adjust, right, your entry point. So your entry point right now is about 109.88, which is this green line over here. This is your entry point. What you can do is to use a buy limit order. See, this is one of the orders that we have mentioned earlier, to use a buy limit order to enter at a more favorable price. So what if we shift, right, our entry price to somewhere about here at, let's say, 109.5. Okay, so let me just adjust this, just double click this. Let's say our entry price now is at 109.5. Our take profit level, the price, we keep it unchanged. Our stop loss level, we keep it unchanged as well. And we click OK. So now if you look at your risk to reward right now, you can see now you're risking $1 to potentially make $1.45, as shown over here. $1.45. Now your risk to reward, right? Let me just put it 1 over here. Your risk to reward, right, has been now improved by using a buy limit order. Of course, everything has its pros and cons. So let me share with you the downside to using this method. If you go with a buy limit order, your order might not get filled. And if the market continues higher, you would have missed the trade. But in this case, right, of course, it's a cherry pick chart. You would have gotten filled and have entered at a more favorable price. As you can see, this market did deep down lower and giving you a better entry price, and now it's starting to kind of head higher. So this is another technique that you can use in your own trading. If as of right now, right, if you're looking at your entry, stops, and target, the risk to reward doesn't quite make sense. You can consider using a buy limit order to get in at a better price. But a few things that I would caution you is to not adjust your original stop loss, because that is at a level, right, that is planned, right, to set, right, where if the price reaches it, it will invalidate your trading setup and you want to get out of it. Don't make it too tight, because sometimes a slight spike, right, might get you stopped out of your trade if your stop loss is too tight. As for target, there's some discretion over here. Since, as you've seen, right, this is a trending market, it's not far-fetched to say that, hey, maybe I can move my target up slightly higher somewhere about here. Since it's a trending market, the price tends to break above the previous high. That is fair enough, right? There, I would say it's a fair call. But one thing to note that if the market right now is in the range market, alright, and you buy, let's say, somewhere about here, and your risk to reward is not very good, don't set your target above the highs of this resistance, because you are expecting the price to break above that resistance to give you this target that you have over here, just so your risk to reward makes sense. And this is really a very bad idea if you're going to shift your target to even above resistance. But for this context that we're talking about here in this uptrend, I would say that is a perfectly fair call. Okay, so are you still with me, right? I hope so. And if you are, smash the thumbs up button. But if your mind, your soul is wandering elsewhere, then hit the subscribe button. Okay, so now let's have a look at another example. This is Aussie against the Swiss franc, as you can see over here. And this is the 8-hour time frame as well. So, you should be a pro already by now. You should even know what I'm going to say. First thing first, market structure. What is this market structure? From the looks of things, this market is in an uptrend, higher high and higher low. Higher high, higher high, higher high, higher high, and higher low, higher low, higher low, higher low. So what about area of value? So clearly this one here, you can see that this market is at this area of support. Entry trigger. Do we have any valid entry trigger to enter a trade? Wow, we have this nice bullish engulfing pattern. Okay, so this candle has reversed and closed above the previous day closing, or rather the highs of the previous day, closing now near the highs of this day. So this is bullish. Great. So what we can do is that we have a number of factors working in our favor. Market structure is up, trading from an area of value, and a valid entry trigger to go long. Let's see, we overlay for 50 MA. Okay, not too bad as well. We even have the 50 period moving average in our favor. Tested once, twice, and now here for a third time again. So now, where can we enter the trade? The next day open. So now next day looking pretty good as well. We enter on the next day's open. Okay, so what about stop loss? I pull out the ATR indicator. You can see the stop loss, right? The ATR value is about 0.003, which is about 30 pips. So here, the way to read this stop loss indicator is the same as you're reading a pip, right? Fourth decimal place, same concept over here. So now let's find out what is the low of this support, right? So we can set a proper stop loss level. So the low over here is about 0.6818. So 0.6818 minus 30 pip. That gives us about 0.6788. Okay, so our stop loss will be at 0.6788. Change this to green. 6788. Green. Entry price. Pretty straightforward. We enter on this opening price of this candle, which is about here. I'll change this to green so we can mark as the entry price that we enter. So now, I am not going to go through the position sizing because you should be a pro by now already. As for target, it's going to be quite straightforward. Your target could set it just before this swing high. So let's say somewhere about here. Okay, I'll change this to blue. Okay, and that's a potential level, right, where you can use to set your target profit. So as of right now, if you just eyeball, you can see that your risk to reward, you're probably risking $1 to make like 80 cents or so. And as you know, you can use a buy limit order to improve your risk to reward on the trade. And to manage your risk, you can use a position sizing calculator to know how many units of currency you should buy, right, such that you risk, like, for example, 1% of your account. So that is something that we have done through previously as well. So one thing to point out is that for this particular example, I want to show you how a losing trade looks like. And in this case, the market, did went in our favor a little bit, You can see that it goes up here halfway through to our target over here before it starts to reverse and then stop us out for a loss of this trade. So this trade clearly is a losing trade. It hits our stop loss, and only after that, right, you can see this trade continue to rally and break out higher. So this will happen, right, in your trading career. I assure you, I guarantee you, I confirm plus chop, right? No matter how good a trading setup looks like, no matter how proper stop loss, how good of a stop loss that you have set, below the price structure, below support, the market, right, sometimes will just, play tricks on you. It will still hit your stop loss, right, and to make you feel the anguish, the pain, only to reverse back and, go so much in your favor, right, and to, make you feel like a loser. So that will happen. Be prepared for it. And this example is really clearly one that illustrated. And how do I know that? It's because this is a trade I took, right, and it happened to me. Okay, so moving on, right, let's have a look at a few trading examples, and this time around it will be a little bit different. It will be trades that I will not want to trade, and again, we will use the same formula, we will use the same concepts that we have talked about earlier. We'll have a look at the market structure, area of value, and the entry trigger. So first one, Aussie against the Japanese yen. So if you look at this chart on this time frame, the daily time frame, you can see that the market structure is up. Great. So what do? We look for buying opportunities. Second thing, where is the area of value? So on this chart and on this time frame, I see that the area of value is around the $82 price point, somewhere here. So right now the price is kind of like in the middle of, I would say, nowhere, so it's not near any area of value. I'll give it a cross. Entry trigger. Is there any valid entry trigger at this point in time? Well, since it's not even at an area of value, I won't really care if there's an entry trigger or not, because I'm not trading from an area of value. And right now the market is still open, it's not closed yet. So again, entry trigger is pretty much, I'll say, no as well, since this market is currently still moving and not closed yet. So as you can see, this is clearly a trade that I don't want to trade. Yes, market structure is up, it's in an uptrend, but it's not from an area of value, and there is no valid entry trigger for me to pull a trade. Second one, dollar against the Norwegian kroner. So same thing. Let's have a look at this market structure. You can see that this one here is in the downtrend, series of lower highs and lower lows, downtrend. Area of value. Is it near any area of value? So again, area of value, I would say somewhere around the $8.70 price point, somewhere here. Price is over here at this point in time, so I would say it's a no. Entry trigger wise, if it's not at an area of value, then really usually I don't even bother looking at the entry trigger. But for the sake of, let's say, this training, we look at the entry trigger, we see there was a shooting star on the previous day, right? So there is an entry trigger, but because again it's not from an area of value, I would choose to skip this trade altogether. So hopefully by now you can understand, right, how market structure, area of value, and the entry trigger give you a good idea to, hey, whether should I be taking a trade or not. Okay, so at this point, I'm sure you have learned a ton, right? We covered Forex trading basics, risk management, some simple numbers to run through, and the final section was actually more of a price action trading, right? Learning about market structure, area of value, support resistance, candlestick patterns, and stuff like that. And if you're enjoying the training, or if you've enjoyed it so far, smash the thumbs up button. If not, then hit the subscribe. And yeah, so for those of you who wants to learn more about price action trading, so basically the stuff that we've just covered, right? The chart analysis, the support resistance, the candlestick patterns, and whatnot. If you want to dive deeper into it, then I've actually got this book over here that will meet your needs. It's called Price Action Trading Secrets. You can get it on this link over here. I'll put this link below. And what is Price Action Trading Secrets? So this is actually a physical color trading book, right, that will be shipped out to you. And in this book, right, you'll learn more about price action trading. You'll learn how to draw support resistance, how to tell when support resistance will break. We dive deep into candlestick patterns, chart analysis, how to trade reversals, how to trade breakout, and much more. So this book over here, you can get a copy here today. And if you get a copy today, I'll share with you a few bonuses. I'll give you a few bonuses for free. First bonus is a digital edition of Price Action Trading Secrets. This is actually a PDF version. So when you purchase the book today, I'll also send you a PDF version, so you don't have to wait for your book to arrive, right? You can start reading immediately. The second bonus I'll give you is this position sizing calculator, so you can manage your risk and never blow up another trading account. So just put in the numbers into this Excel spreadsheet, and it will tell you, right, how many units, right, you should trade, whether it's in the Forex or the stock markets. And then I'll also give you this third bonus, part-time trading secrets, right? This is a webinar, right, that will show you how you can actually trade part-time and become a consistently profitable trader without quitting your full-time job. And one special thing, as you can see on this page over here, I'm giving away 3 bonuses, but for you, the one watching right now, I'll throw in a special unannounced bonus. And the bonus that I'm going to give you, the 4th bonus, is actually the slides, right, of my presentation. So all these slides over here, this entire slides, I will give it to you. So this way, as you're watching this video, and if you want to take notes, at least you have all these PowerPoint slides with you. You don't have to manually take notes and to find out what you've learned. All is in the slides. You can have a copy of the slides and help you with your further revision or or further learning, right, in the days to come. So all this, right, will be given to you for free when you invest in price action trading secrets today. And if you're wondering, right, well, hey, Rainer, what if I don't like price action trading secrets? No worries, because we have a money back guarantee, right? As long as you let us know this, for whatever reason, within the first 60 days, that hey, Rainer, I didn't see any value in this book whatsoever, we'll gladly refund you in full. So just go to this website, priceactiontradingsecrets.com. Click on it, right? You'll be brought to this checkout page over here. So just go to the page, right? You see all these blue buttons along the page. Click on this blue button. You'll be brought to this checkout page at the bottom. Just fill in your name, your address, so we know where to ship the book to you. And this book is like what, $12.90 for those of you who are living in the United States. For those of you outside of the United States, it's like $18.90, and that includes the cost of printing of the book and the shipping fee. That's it. So go to priceactiontradingsecrets.com, right? Get your copy of it. With that said, I wish you good luck, good trading. I will talk to you soon.